Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. Now, in today's program, we take a look at what has influenced the markets in the recent past and what to look forward to going ahead. Now, investing in the local equity markets has not been easy. The all shares in negative territory and even listed property is down by approximately 20%. On the positive side, though, local earnings announcements are trickling in, and most exciting is the news coming out of the US market, with Apple having surpassed the $1 trillion market cap. Truly the biggest company in history to be valued at that level. But there are some significant threats too, such as the global trade war and not instilling much confidence in the market and settling big questions on traders' minds as to how long will the economic recovery cycle last. Well, to help us unpack many of these emerging themes, and of course perhaps the theme of investor fatigue, is Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nair, Senior Portfolio Manager at Sasfin Securities. Gentlemen, thank you so much for joining us today. I think lots that we certainly need to get into given the brief introduction that we've painted, but the last 6 months to a year, Andrew, goodness, not much of a roller coaster ride. If anything, seems as though we're slightly stagnant.
Yeah, I suppose it depends where you look, if you're looking locally or abroad. Yeah. But I suppose if you know, through 2017, the local market did quite well, predominantly, I suppose, on the back of NASPers that did really well through the year. I think it was up about 70%, and as a result, you got quite a nice return through 2017. However, now year to date, as you mentioned, we're in negative territory, and if you actually look over 3 years, you know, the JSE All Share Index, I think, is giving you about 6% per annum.
Sounds like cash.
So, exactly. So it's bang in line with inflation, or slightly ahead of what inflation is now. But in real terms, you've not really made any money by investing on the local equity market, and I think this leads to investor fatigue. And investors getting well, are we ever going to make money in this market, and starting to look to other avenues. But if you look abroad, the global markets have actually done really, really well, and they continue, specifically the US, and we've seen some really strong earnings, which you alluded to. And as a result, the US markets and global markets in general have actually done quite well in recent years.
Let's come back to the local fundamentals, and here more specifically looking at how Reits have performed. We know there's been quite a lot of contentious issues following the news flow from the likes of Resilient. But of course, even retail stocks at one point were the flavor of the month and strong performers. Nesan, are you pulling your hair out here when you take a look at the SA Inc. environment?
I think I'm going to have to start doing that, because you just, you scratch your head for ideas. We had a pretty positive market in January.
Ramaphoria, right?
Ramaphoria, but also global markets were up as well. And we were almost 5% up in January. And then February came, we wrote all that off. Yeah. And we've kind of tried to, get up to the levels that we were at January. But it's been a very mixed performance. And, Andrew actually said last year it was just basically Naspers. In fact, if you take Naspers' performance out of the JSE All Share Index for the last 3 years, we're actually down in nominal terms, and very much down in real terms. And I think, that just puts a magnifying glass on the problem we have here, which is really that of growth. And, until we see a return to some meaningful growth where we start creating jobs and banks start lending again and mines start investing again, I think we're going to see a pretty flat market earnings-wise.
What about the optimism that we still have geared towards a lot of these industrial multinational stocks with the Rand hedge exposure?
Listen, it's still, I think we still remain very positive on them, but the concern is, a lot of them have a very narrow focus. So Naspers, for example, owns Tencent, which is the top 5 company in the world, but Tencent operates really only in China, compared to a lot of the international stocks that we may cover that are a lot more geographically diversified. So giving investors, I think, more diversified opportunity. And the same is true. British American Tobacco, very much in tobacco. Richemont, very much in luxury goods, specifically jewelry, specifically Cartier, which is really diamonds and things. So, very good quality companies, I think, across the board, but doesn't really give you the breadth of investment exposure that I think a lot of people would probably want in these uncertain times.
And that speaks to diversify, diversify, diversify. Hence the opportunities offshore, right, Andrew? But that's also been a challenging environment to operate in, given some of the economic data coming out of the US looking a lot stronger and more optimistic. But some of our favorite stocks in the technology sector have proven to be disappointing slightly, right?
So we're in the middle of the earnings season in the US, and we've seen some really good results. We saw Apple, as you mentioned earlier, and there's been a huge amount of noise around Apple becoming the first trillion-dollar company. You know, it really means it's meaningless, I suppose, at the end of the day.
Well, they could buy South Africa how many times over?
Or any other country in Africa.
Exactly.
But, you know, then you see the Facebook numbers, and we saw Netflix, you know, a few weeks ago as well. And, you know, these companies have done superbly well over recent years. You know, if you just think about Facebook being, you know, one of the top 5 companies in the world, it wasn't even around, you know, 15 years ago. You know, but they get priced, you know, on fairly elevated multiples, Netflix in particular, and then as you see when they disappoint, you know, the share price has come off, you know, quite quickly. And then we saw that bit of a wobble, you know, in the tech sector after the Facebook numbers. I think Facebook was off 20%, but the whole tech sector, you know, Amazon, Google and the like, they all came under pressure. But if you still look over this year, what they've done, tech on average has produced about 20% returns.
Sure.
So if, you know, as a South African investor, if you invest in globally and had exposure, you've actually done really, really well, you know, having exposure to that market. The obvious question is, you know, how long, and you mentioned it in the introduction, how long does this economic recovery in the US, you know, we're now almost the longest on record. I think in a year's time we will be the longest. You know, how long can this continue? And typically markets foresee this, and markets tend to start slowing down, you know, as they start pricing in a recession. And I think that's the key question. When does that US recession come? I'm
glad that you mentioned that, because very briefly before we do go into stocks, the question is then, when it comes to global diversification, where should we be looking? Should it still be US equities? We know Europe has also had a bit of a slump, or should we be looking at the Asian environment?
Don't put all your eggs in one basket. Okay. I think I mean, for me, the US still has a fair amount of momentum. And the reason I say that is if you look at US banks' results in particular, you know, they were very good, but they weren't driven by loan growth. So the Americans are not leveraging themselves. You know, this leverage you see as a late cycle play, you know, and when credit growth starts growing way ahead of what the economy can sustain, then you know there's going to be a correction that's coming, like we saw in 2008 and in the Asian financial crisis as well. And if you go back, you know, to the Great Depression in the 1930s, you know, credit extension, I think, is a late cycle indicator. We haven't seen that in US results, and we haven't seen wage growth in the US. So, you know, if there is going to be a correction, and I don't know whether there is going to be one, it's going to have to be triggered by something else that we have not, you know, seen before. So I think for that reason, we still remain relatively positive, and the tax cuts have helped, that pushed a lot of money in. The oil boom in the US has helped. The US is now the biggest producer of oil in the world, you know, thanks to the fracking technology. So I still think, you know, maybe this rally can last a little while longer.
A little while longer. Andrew?
Yeah, I tend to agree. Look, a correction will come. We just don't know when. So, you know, I think if you talk about tax cuts, you know, these are a once-off event, you know, and now when you start seeing the numbers coming through, which are quite good, you know, the tax cuts aren't going to impact the 2019 or 2020 numbers. And I think that's something that investors need to keep in the back of their mind. You know, with these tax cuts, a lot of these companies are now buying back shares. If you look historically, you know, when share buybacks have been at the highest, it's always at the very wrong time. Companies buy their shares when their shares are expensive, and we saw it in 2007. You know, now we've seen it again. I think that is also an indicator that, you know, markets are perhaps getting a bit lofty. But I would agree with Nesan that this momentum, I think, still carries on for, you know, for the next 6 to 12 months at least.
Sure. So many elements for us to certainly consider, but let's get into the exciting part of the conversation now as we take a look at particular stocks to zone in on as we reflect on the last 6 months and look ahead on equities valuations. Let's kick off with one particular stock in the mining fraternity or resources space, BHP Billiton. And I think in the last, 5 to 6 years, we've seen quite a bit of restructuring with this company, even losing its level of interest in South Africa. Andrew, is this one to keep in our portfolio for the long term specifically?
Yeah, so I think if you're looking for a general miner, diversified miner, I think Billiton, you know, our view is that Billiton is the highest quality diversified miner that's out there. When you think of the others, Anglo-American, your Rios, Glencores, etc. If you think, just go back 3 years, these mining companies had balance sheets that were very stretched. And when you look at today where Billiton sits today, I think from a balance sheet perspective, it's exceptionally strong. And we've seen the share price recover substantially. Likewise have the others. But if you look at their assets, as you mentioned, they no longer operate in South Africa. It's predominantly, low risk countries, the Americas and Australia. They've got coal, copper, iron ore, and operate at the very low end of the cost curve. So I think, if you're looking for a entry into the mining space, I think BHP Billiton should be at the top of your list. The problem is that it's obviously highly geared to economic growth, and with concerns around global trade wars, and a lot of people just dismiss it as noise. But I think we've forgotten what a global trade war feels like, given that the last one happened in the 1930s. So
I'm not too sure if you were around back then.
That were around then are probably not here today. But a global trade war will result in a slowdown in economic growth. There's estimates between 0.5% and 1% that it could take off should this continue. And that would obviously impact not just BHP Billiton, but your commodity miners in general. So there is a slight risk there, but I think BHP Billiton's an exceptionally high quality company.
I want to build up on that and quickly throw in a British American Tobacco there. I know it's been a firm favorite on the show as well for various reasons with regard to innovation and the technology that they show, even though questions around sustainability still exist. But is this company still likely to be relevant in the next couple of months with so many changes happening in the market?
Yeah, I think the questions around the sustainability of these tobacco companies have been going on for many, many decades. This isn't something new. And whilst their volumes admittedly are coming off, as people do stop smoking, they're now starting to move across to these new generation products, this heat, vaping, I'm not even sure what they're called, twisps or something like that. Yeah. But essentially, those products are picking up immensely. They've recently made a fairly big acquisition in the US, so now they've got access to the US market to sell those, provided they get approval to sell those new generation products. Why they haven't, whilst this question around sustainability has been around for many decades, and why they haven't become irrelevant, is that they've got this massive pricing power. If you can think about buying a box of cigarettes, 70% of that cost is essentially tax. So 30% is going to the tobacco company. Now, if the tobacco company wants to increase their price by 10%, it only hits the consumer 3% in the pocket. So they can increase their prices without actually impacting the consumer that heavily. And I think that's a very important consideration that has allowed these tobacco companies to continue to grow their earnings despite this constant threat or talk about not being sustainable.
Nessa, very briefly, your thoughts on British American Tobacco?
Listen, I think Andrew's actually given us a very good analysis, an investment analysis. And
so it's one that you keep in your portfolio?
It's one that we keep, but it's you must remember that a lot of people look at cigarette volumes dropping and say, well, how can we invest in a business like this? But they have such a great pricing leverage. I mean, if government puts up taxes 10%, they just put up their price 10%. Okay, and get a 10% increase that they can blame entirely on government. And of course, the sustainability of it. I mean, government generates around the world huge amounts of revenue from this. So, on the one hand, yes, they're committed to making sure that the health of the population is maintained. But at the same time, they have a little bit of a conflict of interest because they get a lot of revenue on the other side. So I think it still stays there. And these new generation products supposedly contain 5,000 less carcinogens. I didn't really know there were so many carcinogens in a single stick of cigarettes, but it's obviously it's the healthier option. And British American said they'll be able to increase sales that for this year to almost £1 billion. And they, and if they do that, I think we'll see a lot of traction in these new generation products as well. Sure.
Well, those are just two stocks for you to consider, but do stay with us. When we come back from the break, we'll take a look at the likes of Nestle, Naspers, and many more for you to look at keeping in your portfolio. In the meantime, join the conversation by tweeting at CNBC Africa using the hashtag PortfolioWatch, or email your questions to portfoliowatch@abn360.com. We'll be back right after this break. Welcome back. You're still watching Portfolio Watch. Now, if you've just joined us, we're taking a general look at what has influenced the markets in recent times and, of course, what we can expect in the not too distant future. I'm still joined in conversation by my guests here in studio, Andrew Dittberner, who's the Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nesan Nair, who is the Senior Portfolio Manager at Sasfin Securities. Now, gentlemen, before the ad break, we touched on two particular stocks that might be worth keeping in your portfolio for the long term. But when it comes to that N word, Naspers, there are ongoing debates in South Africa's investment arena around price stands and even at beauty salons, with some female investors questioning, is it still worth holding in your investment portfolio given its scale, given its size, and of course, given the valuation? Nesan?
I think so. I think if you look at, if you forget about the way or the media reports rather, just for the time being, on the management structure, the corporate structure, the control structure, yes. The executive pay. You've got to understand this is an outlier in the South African market. It's a huge part of the market because of its size, not necessarily because of its profitability. But if you look at just the underlying businesses, I mean, they've got a 30% stake in Chinese internet business, Tencent, which we all know about, which is growing revenues 60% a year. And, it's a highly penetrated market. Tencent's diversified into other product categories like music, for example, TenPay, which is a payments platform, an e-wallet service as well. Subscribers in Tencent, over 1 billion. Okay, so, a pretty big moat for Tencent, and they may go through periods of revenue, I wouldn't say revenue declines, but revenue misses rather. I think that irons itself out over time. And if you take out Tencent's value in Naspers, sure, you're left with a huge negative value. So, you're getting Tencent at a discount to Naspers share price and everything else in Naspers for free. And the businesses that Naspers has invested in, like Delivery Hero, for example, which they recently invested in, disinvested out of Flipkart a few months ago, but OLX, for example, online classifieds, Mail.ru in Russia, Avito. Yes. I mean, these are all significant businesses.
So long story short, you like it. Valuation-wise?
I think it's underappreciated. That's why I like it.
Andrew, would you agree?
Yeah, I think I'd agree. I think, the only reason Naspers exists, I heard someone saying the other day, is that so value managers can own Tencent. So I think, I'd agree with the valuation. If you do some of the parts, it's a fairly simple.
Let's keep with the technology theme then, because we like Naspers. Certainly we're keeping it despite the valuations and concerns there. Amazon. That's also another one that pops up for a lot of international investors who want some foreign exposure. Is this still one that's for keeps here, Nesan?
I also think so. I think, they've, the thing about technology companies is subscribers, right? And, yes. And market growth and your competition, because we know technology as a theme, is long term. The digital consumption, which is the amount of money people spend on technology and online, is certainly growing faster than in normal forms of consumption. People are buying and consuming more digital content now than they have and will continue to do so in future. So companies that have got leading positions in the digital space and those positions that actually increase ahead of their competition, are the ones to hold, I think. And in the case of Amazon, I mean, it's the leading global retailer, right? There is no second place to Amazon. Amazon also leads, funnily enough, in the cloud business. People don't really know that. The cloud business, if you look at the results, most of the guys had, high 50s, 60s. Amazon even almost doubled their revenue from its cloud business. This is where people store their stuff online that they can access anywhere in the world. Amazon is a leading provider of that globally, bigger than Microsoft and Google and Apple and all these other guys. Apple also offers a similar service to what Netflix does, Amazon Prime Video. Okay, a lot of people don't know about that. They're second place there, which is why nobody's heard. Everybody hears about Netflix. Exactly. So for me, if you can build such leading positions in these growth areas that have got probably another 5 to 10 years. At least before they reach any level of maturity that we can study them like we study a British American tobacco or a AB InBev. I think it's something that it has to be on your radar at the very least.
Certainly the theme of technology coming through. You mentioned the likes of Netflix, and I know we've also discussed this very briefly in the introduction of the show here, Andrew, about the drop in the subscribers that they saw, and of course this adding a bit of a concern again, as unsettling.
It wasn't a drop in subscribers.
Yes, but
it was the market was expecting 7 million new subscribers, and they only delivered 5 and a bit.
And they guided to 6. how on our tenterhooks we are as investors, because we want them to deliver constantly.
For disappointing, even marginally.
And I suppose it comes to the valuation. And I think if you look at Amazon, I think it's up about 100% over the past year. So the valuation, I think we could argue, is fairly lofty. This isn't to say now you got to go and sell Amazon and get out of it.
It's on a 90-forward PE.
Yeah,
which would make a lot of value managers
uneasy.
I think the earnings, we shouldn't be focusing on Amazon's earnings. Rather, if you look at their cash flows, Nesan touched on Amazon Web Services, which is their cloud business. Also, their advertising business is doing very, very well for them. Generating lots of cash. So whilst I think the valuation might be a little bit lofty, I don't think it's one that you want to be selling just yet.
Just very briefly on technology stocks as well, they certainly have come through as a dominant theme throughout the duration of the show. Is this, in other words, for South African investors who want to get offshore exposure into growth stocks or moats, in other words, don't ignore technology stocks in the future?
I think if you do it at your peril. I mean, 10 years ago, the biggest companies in the world were oil companies, right? Exxon Mobil and Chevron and those guys. I mean, now the biggest companies in the world are technology companies. Amazon is a $900 billion company. Apple's over $1 trillion, So I think it speaks to where global consumption is moving towards. Younger people, in particular, spend a lot of time on the internet and technology. It might be a good thing or a bad thing. But certainly, in the next 20 years, I would imagine that a fair amount of the things that we do in our daily lives will actually be accomplished through some sort of technological device or website or app or something. And if you see the trend of consumption trend moving towards that direction, you have to be investing in these businesses.
Exactly. Well, talking about technology stocks, we also can't forget that people need to eat, right? And we consume all sorts of goods in the market. And let's touch on Nestle and Anheuser-Busch. But Nestle, firstly, when I think of them, I think about their chocolates and the recent trademark case that they lost regarding the protection of Kit Kat and the finger of that design of that particular beverage. How do we see this unfolding in the market where, again, we've got, growing populations across the market and the world, and Nestle, of course, being a key competitor and player in that environment? Yeah,
so I suppose if you think, what sector they operate in, it's more defensive, consumer staples. So we've spoken a lot about tech and how well tech has done, but now as we perhaps move into the later, stage of the economic cycle, we're starting to see some of these consumer staples, sit up. So Nestle, I think, returned about 10% over the past month. We spoke about Anheuser-Busch, British American Tobacco. We can look at Reckitt Benckiser. So all of these more defensive companies have actually sat up quite nicely over the last month. And it could be, a bit of a rotation, I suppose, out of tech, maybe towards a more defensive sector being the consumer staples. But if you think about Nestle, it plays exactly to that agricultural theme that you speak about. It's the largest food producer and beverage manufacturer in the world. You've got growing populations, urbanizations, or urbanization taking place, and less land to grow food on, so it plays directly to that agricultural theme. And then if you think about consumer preferences, people are moving to healthier foods these days, and Nestle are focusing on that. I think only about a quarter of their portfolio, if you look at their products, is termed unhealthy. And then you can think about their infant formula in China. Pets is another big theme. People spending money on pets. They've got their pet food division. So they cover the whole array when you think of food and beverages. And as the population grows, you'll think there are a few headwinds that they do face at the moment, admittedly. However, I think the long-term theme remains well intact. Anheuser-Busch, still one that you're keen on?
I think so. If you look at the recent set of results, they had quarter-on-quarter volumes were flat. Now, if you look at AB InBev, they make things like Budweiser and Stella Artois and things. In the US, which is their biggest market, volumes are contracting. Brazil is also another big market of theirs and can swing either way. With the World Cup recently, they had decent enough volumes, notwithstanding the strike there. But AB InBev's growth story is really going to come from Africa and Asia. And I think in the last set of results, you're beginning to see that they're obtaining traction. They just, a few years ago, swallowed the second biggest competitor, SAB Biller, which we all missed from the stock exchange. But I think the investment case for sustained growth in their growing markets is still very much there. And it's going to be a question of to what extent can they abate slowdown in the US, and to what extent can they actually supplement or augment their growth in emerging markets to compensate for the difference. But a very well-run business, still one of the highest EBIT margins in the industry. They're the biggest player, yet their EBIT margins are north of 35% compared to Heineken, which is the second biggest player by far, but only managing 25%. So I think in this sector, showing us how important scale is.
Very briefly, and perhaps we can wrap up on that particular note here, Andrew, with regard to the companies we've highlighted, BHP Billiton, Anheuser-Busch, Naspers, and even the likes of Amazon, all of them really large and significant players within their fields and industries. Despite the short-term headwinds that they've been facing, are these still elements for us to consider as investors when it comes to our long-term investment thesis? In other words, the bigger the player, the better for your bet in the long term. Would that be correct?
Look, I suppose you want to have exposure to the largest players in the markets. They've got scale. They have these, we've spoken about moats before on this program, and I suppose they have all of this intact, so they can generate higher returns on capital. The trick is that as Nesan said earlier, when you think 10 years ago or 20 years ago, the biggest companies were oil companies. Now today, as I said, Facebook wasn't around 15 years ago. Today it's in the top 5. You want to also be able to identify tomorrow's stars and not yesterday's. So these big guys, some of them might be yesterday's stars, admittedly, like your oil companies were. But you do want exposure to some of these fantastic businesses that are disrupting the likes of your Amazons, etc. You definitely don't want to not hold them on the premise that they're big.
Exactly.
But hopefully people still drink beer and eat Kit Kat.
But with those themes are certainly top of mind, that's how we wrap up Portfolio Watch for today. A big thank you to my guests for joining me, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nesan Nair, who is the Senior Portfolio Manager at Sasfin Securities. From myself and the team, we want to encourage you to keep your questions coming. And of course, you can tweet us at CNBC Africa using the hashtag Portfolio Watch, or email portfoliowatch@abn360.com. Until next week, have a fantastic week ahead.